Forex or foreign exchange market is the largest financial market in the world, larger even than the stocks market, with a daily volume over the 5 trillions. Imagine if you could get a tiny slice of that market. That would eventually be millions of the billions of dollars. Forex market is as old as the money itself. Maybe not in the front we know it today, but it did. Under almost every video we upload, there is at least a few comments about people claiming that they have made a fortune trading in the forex exchange market. Usually they are directly recognized as spams, but sometimes they do get published. Here is in this video we will find out if they really can make money trading on the forex market. But to figure out we have to understand a few key concepts first. What is the forex market and how exactly does it works? What they are the main ways to trade, use the market's money, and finally why most people end up getting scammed. Hey, Wednesday Mind, if you want to support this channel and help us to make more videos and to your name at the end of the next video, make sure you check out our Patreon page. In fact, I will be posting weekly updates about the market or something I will pick up a company and analyze it to figure out if it's a good investment or not. So if you are interested in all of that, then make sure you check out our Patreon page. And now let's get into it. Forex for dummies. When we talk about globalizations, we mention things such as the tourism, international flights, shipping, but we often ignore the role of the financial institutions in making that happen. In fact, without forex international trade is impossible since the existence of the money. Every country had its own currency, even when the gold was the currency of the world. Not all gold coins were equal. Some of them were made quality gold, others were mixed with other kinds of metals. Hence, merchants always had the problem of measuring the value of different currencies. First toward to today, even when we created paper currencies and completely demolished the gold standard, that problem didn't suddenly vanish. In fact, it became even more complicated since each country created its own currency. Here are 180 currencies all around the world. Let's say you live in the United States, and since it's summer, you decided to visit your northern neighbor, Canada. You can't simply use your US dollars there. You have to buy Canadian dollars, and only with them you can pay for the goods and the services in Canada. If, let's say hypothetically, the US dollars is equal to 1 Canadian dollars, using $100, you will buy 100 Canadian dollars. But if you look at the real world, 1 US dollar is equal to 1.36 Canadian dollars, which means using $100 US dollars, you can buy 136 Canadian dollars. Apple can simply hire Chinese workers and pay them in the dollars to manufacturers your iPhone. They can only pay them in the Chinese yuan. That's why they have to buy yuan first. And if they need to buy LCD screens for the latest flagship from Samsung, they have to purchase South Korea won to pay for these screens. And guess where all these currencies transactions take place? Exactly, the foreign exchange market, or Forex in short. Can you really make money by trading that money? The year 1996 saw the first generation of the Forex online trading platform. The internet made Forex trading so accessible that it became mainstream, exactly like the internet made it easy to invest in the stock market. There are essentially three ways to profit the Forex market. The most popular is probably the spot market. It's just a fancy word for the transactions with immediate delivery, such when you buy gold, for example, you don't wait to receive it sometime in the future, like future contracts, but trader own it immediately. But in this case, we are talking about the currencies. fluctuated all the time, and if you end up guessing right when the certain currency rises in value as you do with stocks, you make profit. At the end of the day, the currency is like any other commodity that's driven by demand and supply. Let's say, for the sake of the examples, the US dollars equals to Chinese yens. If demand for the Chinese yens rises, or in other words, if more people decided to buy the Chinese yens because I don't know. They have set up factories in China. Now they have to pay their employees. The value of the Chinese yen will increase. So 1 US dollars will no longer be equal to 2 yuan dollars, but rather to 1.5 yuan. Of course, it's extreme oversimplified, but that's how it works in short. The number of factors that can influence the demand for the certain currencies are so many that we can't cover all, even if its video is going to be an hour long. So let's take a look at the few important ones. The economic performance or the political situations can influence the demand for the certain currencies or to perceptions about the future of the economy. In June 2014, a single British pound equals to 1.7 US dollars. But then rumors spread that UK might leave the UA. That spread off a lot of investors, so they pulled their investments, and demand for the British pound slowly began to fall. Today, with the British pound, you can buy 1.25 US dollars. Or take an example of the China. For the last 20 years, the Chinese economy was growing to unbelievable rates. More businesses shifted their manufacturers to China. As a result of that, the Chinese yuan kept rising in the value against other currencies such as the US dollar. Traders in the Forex analyzed the market and speculated about the future and the particular currency. If they expect it to rise, they buy a lot of it, hold it till the price rises, and then sell it, exactly as you trade stocks. But that makes things market much more fluctuate. It is the brokers often provide their clients unbelievable leverage ratios 1 to 1,000, and very common in the forex market. That means that if you trade using your $1,000, you can hold positions worth $100,000. If you end up making a small percentage of the profit, you will be huge. On the other side, there are the futures and the forwards contracts. They aren't really common among the trades. They are more open to used by multinational corporations. Let's say the company A that's based in the USA wants to sell t-shirts in the United States. Say that t-shirts cost 10 Mexican pesos to produce it in Mexico, and company A wants to sell it for the $15. And let's say hypothetically the US dollars equals to 1 Mexico peso. In this case, company A should make $5 in profit for each t-shirts sold. But what if the time in Mexico firms manufactures all the t-shirts and drives them to company Mexico? Peso rises in the value, where let's say 1 peso equals to $2, so the single t-shirts would cost $20, and the company A will make a loss if it sells them at $15 each. To prevent such things from happening or any other risk of price fluctuations, companies often buy futures contracts to fix the rate at which the transactions will be completed. And if you want to buy the cool t-shirts where you don't have to deal with any kind of the price fluctuations, you can visit our store. Finally, we have launched our merch t-shirts holders, phone cases with the beautiful designs that you will definitely love. So make sure you check out our stores. And did I tell you that you will be supporting our channel to make more similar videos? The link will be in the descriptions. Fourth, the problem with the forex trading. Forex the market of for losers, unlike the stock markets, where you can analyze the certain company, figure out if it's undervalued or overvalued. You make the rational decisions that at least in the long run will pay back. Forex is different. It's more like the speculations. They are the simply two manufacturers that influence the certain currency from the tourism to geopolitical risk, which makes the market even more volatile. In fact, the major players of the are the banks that trade among each other in the huge volumes that could easily crush you no matter how big your capital. So it's common for the amateurs to easily lose their positions when they aren't educated about the market. They can get emotional and make a wrong move. In some countries, the forex market is entirely underregulated, which makes it even riskier. A lot of the brokers aren't trustworthy and can mislead their customers by bidding against them. For example, remember the unbelievable leverage you can get in the forex market we talked about earlier? Well, there's the downside of it. Many brokers firms went bankrupt due to the lousy leverage decisions. So if your positions losses value to a point where you no longer meet minimum margin requirements, your brokers will liquidate assets to help assure that you don't lose more money that you put into the account. Beginner traders who are new to the game often make these mistakes and quickly lose their capital. It's not to say that anyone who trades in forex, but risks are extremely high. If you guys have enjoyed this video, make sure to give it a thumbs up, and if you want to see more similar videos, then hit the subscribe button and the bell beside it. And don't forget to check our Patreon page to support us to make more similar videos. Thanks for watching, and until next time.